The Fed says there's evidence of stabilization, but Warren Buffett in Omaha has a gloomier forecast. Let's get the bipolarity from Michelle in New York. Hello, Michelle.
Hello there, Bernie. Well, let us first start with the Fed. And the Federal Reserve says the recession is easing, that the pace of economic contraction is slowing, and it's predicting inflation will remain subdued for some time. The Fed is also deciding to leave its $1.75 trillion bond purchase program unchanged, and it kept the benchmark interest rate unchanged as well. And the Fed also says that the rate will stay at exceptionally low levels for an extended period. Now, the Fed does want to calm investors concerned that the $1 trillion expansion in its balance sheet will fuel inflation, and it stressed that it is monitoring the size and composition of its balance sheet, and the Fed thinks we are staying on the right track, saying that the pace of economic contraction is slowing and that conditions in the financial markets have generally improved. But the Oracle of Omaha has a more somber forecast. He's expecting unemployment to rise, and he thinks that a second stimulus package will be in order.
We're going to have more unemployment, and we have not, the recovery really hasn't gotten going. I mean, it will. I want to emphasize that. But unemployment lags the recovery anyway. So even if the recovery started today, unemployment would go up for a while. So it's very, very likely to go above 10%, and there's no telling how much above that it'll go. I think you may very well have to do it. So I don't know the answer to that now. But I would say this, so far, you know, it looks like we're going to need more medicine, not less.
And as for the man dispensing the medicine, well, Buffett is a big Bernanke backer. He says he gives the Fed chairman his full vote of confidence. Bernie?
Okay, now the big question is, does the Fed have it right? What does history tell us about these things? Michelle, stick around for the convo. Sean Darby, Chief Asian Emerging Market Strategist at No More International, with us on the show today. Hello, sir.
Very well.
Did you like the language that the Fed used today?
I think it was very much in with market expectations. I think part of the market, though, would have liked to have seen a more aggressive ramp-up in government bond purchases and mortgage-backed securities.
I thought the market was looking for their exit strategy from all that.
Well, I think there's two things. Certainly there's a group, a community within the Federal Reserve which is actually very worried about the overall program that the Fed has running at the moment and would like to start to see an exit strategy. The bond and the sort of real economy investors are tending to want to actually see further emphasis on bond purchases because they don't see as yet much traction in the real economy. Mm-hmm. So with yields going towards 4% and rising gasoline prices, there's a risk that actually the economy and its green shoots will get unfortunately choked off.
Yeah, somebody told me the other day that far from quantitative easing, they're actually doing quantitative tightening. They're saying one thing but doing another. What did he mean by that? I'm still not clear. And is that the case?
Well, certainly, if you look at the Federal Reserve balance sheet, at the moment, they really haven't expanded things over the last 2 quarters. All they're doing is just changing the composition of the balance sheet more towards mortgage-backed securities and the U.S. Treasuries. A large part of this sort of program in order to resuscitate the banks is being done through the FDIC. So in one hand, the Federal Reserve is removing itself from the more day-to-day activities in trying to finance the banks, but equally it hasn't really ramped up the expansion of its balance sheet as one would have expected by now.
One of the criticisms I heard this morning and that we talked about at some length was that the Fed has not really adopted a low inflation kind of a doctrine. They haven't really nailed that down or illustrated, how exactly they're going to keep us within a certain comfort range. And that's what the worries are out there, as we've seen the yields across the 2, 5, 10-year spectrum creeping up, something like 70 points, right, in the last couple months. Yeah, and that's here to stay, and that is going to get worse, and there's really no abatement possible there.
Well, with final demand weak, presumably the Fed can err on the side of actually letting inflation perhaps rise much higher than they would have been normally comfortable with an economic cycle. So that's the first thing. The second thing is, of course, that rising bond yields may not necessarily represent just inflation expectations. It's also representing worries about overall fiscal issuance, possible loss of the AAA rated status, and of course worries that foreigners will start to remove themselves from the bond markets given the heavy issuance payments going forward.
Yeah, there's been a lot of talk of that. It's really more talking the talk than walking the walk, though, right? Because sovereign countries keep buying U.S. Treasuries. They don't want to dilute it. They don't want to torpedo their own investments. Do you see any kind of a disaster scenario looming anytime?
Well, certainly the Europeans are particularly critical of some elements of the U.S. Quantitative easing program, blaming it that it could be actually create another bubble. And of course, some people worry that if they do another fiscal package, there's just not enough hands out there that can possibly buy U.S. government bonds, given that they've already appetite's already insatiated.
Well, that's got a lot of credibility coming from the looming banking crisis with no stress tests over there in the Eurozone. Okay, so net, we can talk about this until the cows come home. Where are we headed down this path? Is this the best scenario unfolding that we could have hoped for, given the tools we have?
Well, I think at the moment the Fed is trying to walk a very, very straight path in the sense that it wants to maintain some sort of economic trajectory. And as Warren Buffett was highlighting, the fact is that the US tends to run on the unemployment rate, and until that starts to turn down, I don't think you're going to see much change in the Fed policy. But the key is really that it may be that we're going to see higher yields over the second half of the year in the United States, and that may not be something that, as I said, most investors have been sort of discounting.
Okay.